Everyone talks about negative gearing, but how about positive gearing? Why aren't more experts talking about this? Hi everyone, Tuan Duong, founder of Duotax, here for another video designed to help you become a better property investor. When it comes to property investment strategies, positive gearing is definitely thought to be a more conservative approach, with nearly 60% of Australian investors leaning towards negative gearing. In today's video, I want to talk about positive gearing and why it should also be an option on your investment strategy radar. I'll also compare it to the negative gearing strategy, so stick around to see which strategy best suits your property goals. But before getting started, I want to be clear that this video is for informational purposes only. In no way should you interpret this as tax advice. We always recommend working with a qualified accountant or tax agent to give you the best advice for your situation. With that said, let's get straight into it. Let's start with what the term gearing means. In simple terms, it basically means that you've borrowed money to buy your investment property. So, if your property is positively geared, this means that your rental income is higher than your home loan repayments and any other property costs. In other words, you are consistently making a profit from your investment property. Let's take a look at an example. Bruce bought his first investment property in Melbourne in 2020 for $485,000 in a suburb just outside of the city and managed to rent it out for a solid rental of $575 per week. Assuming that the property costs he incurs from owning the property amount to $460 per week, Bruce can cover the expenses with a rental return and have a surplus of $115 per week. This means that his property is positively geared and he ends up using the surplus to reduce the size of his home loan. Besides the fact that you'll be generating a consistent cash flow from your property, there are some other advantages that you can benefit from. For example, your lending power increases. Having a positive cash flow boosts your income, meaning you could have an easier time securing another home loan to expand your property portfolio. And if you already have more than one property in your portfolio and one is currently negatively geared, your positively geared property can help you cover the shortfall. But there will be some tax implications with a positively geared property. Just like the income you receive from your wages, the income you generate from your investment property is subject to tax. The amount of tax you'll pay will depend on the tax bracket you fall into. The key benefit of a negatively geared property is that you can offset the loss from your income. So that's why people tend to steer towards negative gearing as a strategy. But if you claim all the different beneficial tax deductions on your positively geared property, you could also reduce the amount of tax you pay each year. The top 3 investment property tax deductions include depreciation, interest on your loan, and rental expenses such as rental agent fees. To find out more about the tax deductions you can claim, check out our video that covers 17 tax deductions you can claim on your investment property. Now, you should consider a few other factors when going for a positive gearing strategy. For example, positive geared properties are typically more challenging to find than negatively geared properties because positively geared properties are in high demand. And high demand means higher prices and lower rental yields. The lower the rental yield, the harder it is to have your property produce a positive cash flow. So, they're harder to find, but they do exist. You just need the right team in your corner to help you find these properties. You'll also typically have to pay more capital when you're first buying the property. But by paying more cash, you're decreasing the amount of money you have to borrow from the bank, and a smaller mortgage repayments will make it easier to generate a profit from your rental income. At the end of the day, it all comes down to planning and keeping up to date with economic and property market fluctuations. That's why we emphasize building a team of property investors and other property professionals to help you navigate through making the right decisions for you and your circumstances. Make sure to check out our video on the 4 property professionals you need in your corner. Before heading off, let's have a quick look at the differences between negative gearing and positive gearing. So with positive gearing, your earnings are more than your expenses. And with negative gearing, your earnings are less than your expenses. With positive gearing, you need to pay income tax, but you can use your loss to reduce your income tax with negative gearing. You may be paying more in income tax, but positively geared properties produce extra cash flow, whereas with negative gearing, you're going to have to cover the costs of the shortfall. So there you have it, positive gearing in a nutshell. If you have any questions about claiming depreciation and other tax deductions on your negatively geared property, drop a comment below. Otherwise, make sure to like and subscribe to our YouTube channel for more property investment tips. I'm Tuan Duong from DuoTax. I'll see you next time.
you